welcome to the Freedom Finances Show. It's great to have you here today. My name is Bradley Valentine, and it is Thursday, September 26, 2024. Today we're going to talk about some basics of investing and how to get a better understanding of the stock market. But first, there's some good news out there, and it's great to start with awesome financial news that's positive for everyone. Interest rates, according to Freddie Mac, are at a 2-year low of 6.08% for 30-year mortgages. This is awesome news for anyone interested in buying or even selling their homes. About a year ago, interest rates in October of 2023 were as high as 7.79%, which truly was too high for many people to even consider buying a home. We'll likely see more interest rate cuts from the Federal Reserve before 2024 is over. So while the mortgage rate news is good for today, it could get even better for the next few months. This interest rate news from the Federal Reserve and from Freddie Mac has helped the stock market make major gains in the last 10 days to 2 weeks or so, leading many investors to jump in. High stock market prices may lead some investors to be a little timid as they wait for price drops. Now, we're going to talk about investing and some investing basics today. So let's start about when to invest. You've likely heard the investment advice, buy low, sell high, and this is great advice to make money. You know what else is great, amazing advice? Invest in the real estate for a low initial cost and then sell for a major profit. Yeah, that's obvious. So when you hear buy low, sell high, just know that you're not getting quality practical advice. But let's talk about why. So the first problem with this statement, buy low, sell high, is that it assumes the investor has the foreknowledge of when the prices will be high and when the prices are going to be low. If we all knew that, we'd be millionaires. We'd always buy a stock as low as it's going to get in the next couple days, and we'd always hold on until it's going to reach its peak. So that advice, while true, it's not really good practical advice. What we should be doing instead as investors and our mindsets, instead of just thinking about price levels, consider timelines and consider the quality of investments. So let's start with timelines. Generally speaking, as we've said many times before, stock prices, they go up. Now, there are some stocks that have a relatively static price and some that even go down. But overall, stocks go up. We're going to talk about stocks that go down or even stocks that stay static later. So if your mentality is to invest in the stock market, but I'm going to wait for the perfect price, then you should know there's a cost to waiting. To understand this, let's really look at the history of the stock market using the S&P 500. So the S&P 500 is an index that's a measurement of the top 500 companies in the US. So if you made an investment of $1,000 in the S&P 5 years ago, you would have almost doubled your money today, and you would have about $1,945. That's somewhere around a 92% increase. So as we've established, the stock market goes up, and investing now usually means that you'll have more money tomorrow. However, the stock market doesn't always go up every single day. It doesn't necessarily mean that you'll have more money tomorrow because it could go down tomorrow. Sometimes the stock market takes a hit, and sometimes you lose money. For example, that $1,000 that you would have invested in the S&P 5 years ago would be worth less than $1,000 just 6 months after your initial investment. Now, if you got nervous and you pulled your money out 6 months after you made that $1,000 investment, you would have taken in and sealed in a loss. However, if you stayed the course and understood that the stock market was going to recover and left your money in, you would have watched your money nearly double in just 5 years. The cost of investing is very important to understand, but let's take a quick pause from just the idea of investments to talk about a term. This term is called opportunity cost. If you've ever taken a finance basics class or economics class, you've likely heard this term. If you haven't heard it, let me break it down real quick. So, opportunity cost essentially means that there is a cost to whatever decision you make. This cost doesn't necessarily have to be financial in all instances, but sometimes it is. So, let's use an example, one that isn't financial. Let's say I want to sit down for the next couple hours and read a book. I think we all agree that reading is good, it's generally harmless, it's good for your mind. However, what is the cost to reading for the next 2 hours? The opportunity cost is what I'm unable to do because I'm using my time reading. For example, if I spend the next 2 hours reading a book, I can't clean my house. I can't do laundry, I can't do dishes. I can't work out because I'm reading. Now, maybe I make the decision that I would rather read than do many of those things. Awesome, but there's an opportunity cost. So that's an example of opportunity cost, and everything that you can't do because you're reading is an opportunity cost. The reason I bring up opportunity cost is because it's important to understand that there is a cost to every decision, including investment decisions. If you make a decision to invest in Apple, there's a cost. Yes, there's a financial cost to your investment, such as the dollar amount taken out of your bank account, but there's also an opportunity cost. So if you invest $1,000 into Apple, then you no longer have that $1,000 to invest somewhere else. So why is this important? It's important because all decisions investing has pros and cons. You should learn from your mistakes when investing, but don't focus too much on what you've missed out on. Apple may not have been the best investment for $1,000 a few years ago, but if you did invest 5 years ago, you would have increased your funds by over 300% and gained dividends. That's a great opportunity. Now, you should be happy that you've increased your money by 300%. However, some people, many beginner investors, they make the mistake of chasing the best stock out there, and they're too worried about the opportunity cost. So, patience, it's not going to get you rich quickly, but patience will give you the opportunity to increase the value of your money year over year. You may not be able to be a millionaire in the next year or two just by being patient, but you can make millions in investments in your retirement accounts, 401ks, IRAs, if you make smart strategies and you're patient and avoid poor decision making. Speaking of poor decision making, let's talk a little bit about risks and the risk of investing. Another cliche in investing is high risk equals high reward. So this is technically true, but what also is true is high risk equals high losses. Sure, if we could take a high risk and get a high reward investment, we would do that every time, except there's a drawback. You may get huge losses. Really, what the saying should be is high risk usually equals a high reward or high losses. But that's not really catchy, is it? What gets people is the high reward part of a high risk investment. Some people see short-term gains of 2, maybe 300% in just a couple months, and they want to jump in on that train. What happens instead of seeing another 2 or 300% increase is that this high risk, very volatile investment is people put too much money in and the growth period has already ended. So while investment may have a growth of 200% in a couple weeks, that investment is likely so risky that it's so volatile to bank on. $1,000 turns into $250 just a few weeks later, and maybe that stock never goes up. Okay, you may be thinking, well, Bradley, you said the stock market always goes up. Yes, this is true. This is a true statement, but it does not mean that all stocks, all investments will always see an increase. What it means is the average of all stocks and investments in the market is what will always go up. So, are high-risk investments bad, and should they be eliminated from your portfolio? No, not necessarily, but there are some things you should know and things we need to talk about before you make high-risk investments. So first thing to do is consider whether or not an investment is risky. If a stock has been in the news lately for major short-term gains, It's likely a volatile stock and a risky one. But instead of guessing, do some research. Stock prices, stock price histories, they're super easy to find on the internet. Personally, I like to use Yahoo Finances, but many people could just do a quick Google search to see the history of a stock price. So, first things first, do your research. Don't take advice from your coworkers because they heard this awesome stock tip and they made $100 or they watched a YouTube video. Why? Because if they knew what they were doing, they probably wouldn't be your coworkers still. Once you have an understanding of how risky an investment is, ask yourself, how much money are you okay parting with? The idea is the higher the risk of an investment, the more okay you should be with losing that money. Let's give ourselves an example here, and we're going to go to the amazingly hilarious meme stock of GameStop. So, GameStop is an extremely risky investment for anyone over the last couple years, and you really shouldn't expect to make a lot of money. However, every once in a while over the last few years, GameStop has seen some great gains in short periods. Now, usually those gains are quickly eliminated, and many people think they're going to get lucky, and many people do get lucky, and they sell high. So, if today you want to make an investment in GameStop, go for it. Just know that it's risky and you might lose a lot of money. You should be sure that you're okay with losing most of your money in a GameStop investment. Now, if you're not comfortable with that, if you're not comfortable with putting $500 into GameStop and potentially losing much of that money, then simply don't make the investment. Let's talk about another risky investment, maybe slightly less risky than GameStop, but Bitcoin. So, Bitcoin has seen some awesome growth over the last several years. However, it's an extremely new way to invest with very little history and very high volatility. The problem is that many people find themselves in the trap of investing in Bitcoin when it reaches all-time highs. Many people invested when Bitcoin was over $70,000 a few months ago, but today it's just worth around $64,000. A few weeks ago, Bitcoin was in the mid-50,000s. This means that if you invested thousands of dollars of your own money in Bitcoin when it was over $70,000, then you'd be at a loss today. You would have been at an even bigger loss a couple weeks ago, but you would have made your money up. It's important to understand how much volatility there is from $70,000 to $64,000 today in just a few months to $55,000 a few weeks ago. That sounds scary because it is. Now, this will scare many, but remember, it's an risky investment. The goal is to get your money to grow. If you're trying to buy, or if you're trying to time Bitcoin and buy low, sell high, you're probably going to fail. What you should do instead is invest as much money into Bitcoin that you're okay with losing. Do you want to invest $1,000 into Bitcoin today? Fine. Just make sure that $1,000 is not important to your short-term future. Now, I don't want you to think that Bitcoin is the worst possible investment. Just, it's risky, it's volatile, it's new. Personally, I do have some money invested into Bitcoin, but it's money I'm okay with losing. Obviously, you should never be okay with just throwing away money, but I understand that Bitcoin is a high-risk stock or a high-risk investment, and I'm okay with losing some of my money. Okay, let's quickly go over one last thing about investing and risk. And this is, you should understand that the more diverse your portfolio is, the lower risk you have in that portfolio. This means that you're not putting all of your money into one security. Instead, you're spreading your risk amongst many investments. Okay, last thing we're going to talk about with stock and investment basics today is the difference between two types of investments. There are dividend investments and growth investments that I want to talk about today. We're not going to go too much into depth and go into every single detail and all the complexity. Now, we do actually have some articles on freedomfinances.org. If you're interested in learning much more and spending a lot more time into these, definitely check out the website. All right, let's start with a dividend investment. This is an investment that you buy into, not just for the gains of the stock itself, but for the payout that it gives. So here's an example. If you invest into Coca-Cola stock, you likely aren't going to see major gains in your portfolio. $1,000 today might mean something like $1,025 in 2 years from now, or maybe even less than that, maybe even less than $1,000. So why invest at all? Well, Coca-Cola pays you to be a part owner and own some stocks. This means that they will give you an annual dividend yield of 2.72% as of today in 2024 to own the stock. They essentially give you cash each year just to own the stock. Now you can take that money, you can reinvest it into the stock, the Coca-Cola stock, cash the money out, use it to spend, or you can use the money to invest in other stocks. You can do whatever you want with the money. One thing to understand with dividends are there's a lot of tax complexities, but generally speaking, you're going to get into a dividend because it's low risk, it's low growth, but a strong dividend yield like one from Coca-Cola means that a part ownership in the company is a low risk investment with a payout. So the other type of investment, which is different than a dividend investment, is a growth stock. A growth stock is pretty much exactly what it sounds like, and it's an investment that you expect to grow in value. A good example here could be Tesla. Tesla does not pay a dividend, and some people may say, well, if you don't pay a dividend, I'm not investing. Well, instead of paying dividends, Tesla pays you in growth. So let's see if it's a good decision, if you made a good decision 5 years ago to not invest in Tesla because they don't pay you a dividend. So let's say five years ago, you invested $1,000 into Tesla instead of Coca-Cola. Well, guess what? You would have increased your money by 1,567%. What does that mean? That means $1,000 5 years ago would be worth over $16,000 today. So did you make the right choice? Well, maybe you're saying, why would I ever pick a dividend over a growth stock? That is a good question, but here's a few reasons, here's a few answers for you. Generally, growth stocks are more risky than dividends. There's no guarantee of growth in a growth stock. Eventually, the growth in a growth stock or a growth company subsides at a point. So the question is, how long will Tesla continue to grow? It's impossible and it's difficult to say. So it's really important that we understand these different types of stocks when we're making our investment decisions and how they'll impact your portfolio. All right, let's wrap it up, but before we do, I want to do a quick recap and summarize some of the things we talked about today because we did talk about a lot. So the first thing we talked about today was investing early versus timing your investments. That is a more sustainable strategy than buying low, selling high, because that's so obvious, and timing the market is difficult. We talked about how every decision has an opportunity cost, which is the cost of not making a different decision. Don't get too caught up in your decision making, but instead find the best investments out there and learn from your mistakes. Do a lot of research and educate yourself. That's what we're here for. When you're looking at high risk investments, remember a couple things. The more risky your investment, the more you should be okay with parting with those funds. Second, the more diverse your portfolio is, the lower your risk is. And finally, we talked about growth versus dividend investments. Dividends are payments to the owners of the stock for holding the stocks, and they usually don't make much major growth. However, growth stocks are generally more risky, but allow the value of your dollar to increase as time goes by. I really hope you learned a thing or two today, and I appreciate you spending time with me. As always, my goal is not to influence you into picking one stock or one investment over another. Instead, my goal is to educate you into making the best decision and finding the right stocks and investments for yourself. I'm excited to say that we are now on every major platform, including Spotify, Apple Podcasts, YouTube, and iHeartRadio. Thank you so much for joining me today. Once again, my name is Bradley Valentine, and I hope you have a great day.